teach is preparing for college and careers. And so I just want to touch on a few things to maybe help your college journey a little bit better. So first of all, it's real important to work hard in school and to get decent grades. You don't have to be top of your class in order to get scholarships and grants, but that just improves your chances of getting a lot more money and also admission to college of your choice. So working hard and getting your stuff turned in and just making sure that you're doing your best. A couple of things to consider when you're going to college and wanting to earn some money to help alleviate any debt would be the standardized tests like the SAT, which that is through College Board, so it's collegeboard.org, and then the ACT, which is act.org. And so both of those tests, you can take them as many times as you'd like to improve your score. Typically a lot of students tend to be better at one than the other. For example, my daughter took both of them initially, did really well in the ACT, and so she took the SAT another time, and then the ACT again, and did better, and so she just focused in on the ACT. The way they're set up, sometimes they work better with different students. So you can take them as many times as you'd like and to improve your score, but check with your college because a lot of colleges now, kind of since COVID, those tests are optional. So check with your school that you're interested in if they even need those scores, but that's optional. Let's see, the other thing to get ready for trying to get free money for college would be filling out the FAFSA, which is FAFSA, which is the free application for federal student aid, and it's just .gov. You want to do this, so like you say you graduated in May, so the students that graduated just this May, if you are going to college, you are a senior, the October 1st of your senior year is when you need to fill that out if you're planning to go to college in August. So it opens up October 1st of the year prior to when you want to attend school, and it is kind of that's first come first serve. They kind of say that just sooner the better because so they have the funds there. But it opens up October 1st. You fill that out. I have 2 students in college of my own right now, so you may or may not apply for it. I may not apply for it. Everyone can apply for it, but you may not get some of the aid if your income is a little above what they have set. But it doesn't hurt to try. So both my kids did. They did not qualify for the free aid from that way, but my daughter's college requires you to fill that out, for her to fill that out in order for them to get her aid. So she applies for that every year, and we know she's not going to get any federal aid, but her university to give her aid, she has to do that. So my son doesn't get any, so he only filled it out his first year, but we'll talk about scholarships on that. So there are some things that you need when you fill out the FAFSA, and that would be you need to create a FAFSA ID. So you can just go to the FAFSA.gov, which is the free application for federal student aid website, and you can create your federal student aid ID, which you should create that a few days before you plan to apply. So before October 1st, because it takes up to 3 days before you can use that ID. You'll need your social security number as you fill that out. And it is something that you can, as a student, fill out. Your parents don't have to do it. I have students in my class who walk through a mock one. You just need the information ahead of time, and then it walks you through it. My own children have always filled their own out. We've never helped them with it. So you can do it, so don't be intimidated by that. But you'll need your social security number, your driver's license number if you have one. If you don't worry about that step, you can skip that. You and your parents' income tax return from a previous year. If you go to that website, it'll tell you what year you'll need that tax return. You need records of your untaxed income, such as like if you get child support, interest income from any investments that you have or accounts, savings accounts that you have. Records of your assets, so that would be your money, so that would be savings, checking accounts, valuing stocks, bonds, and real estate, excluding your primary address. Also the list of schools that you're interested in attending. So those are the 7 things that you would need to fill out the free application for federal student aid. And then when that goes through, you'll get information about what you qualify for. Oftentimes, federal student loan, those federal student loan options are on there. You can check that you want those or you don't, but so they're on there with, as well as grants that they would offer. So you'll get information, a letter about that. But if you're looking at, also that's not going to pay for everything. College is very expensive. So for additional free money, you can also definitely check the universities that you're interested in and see what they can offer and how, scholarships you can apply through them. So they have lots, and they'll have that on their website. You also can do Google searching for like what you're interested in. If you're interested in marketing, you can just type in marketing scholarships and go through there and see if you qualify for those. Or if you're interested in healthcare, so you can be specific that way. You can also, there's a website called fastweb.com, and that has, you just kind of filter, put your information in, and it will match it's free scholarships to your interest. But they have crazy ones on there as well. They have, left-handed, just red hair, just different things like that you could apply for as well. But so you just do Google searching, and you'll just, even if you're getting like $500 here, $250 here, those do add up. So it does, and it's just free money. Another thing that I do want to make sure that students, there's other ways too, but like maybe your parent works at a company, you might want to check and see if they offer scholarships for students of employees, so that would be something to check out. But what I think is missed a lot, I know with students that I have, a lot of the students I have at Belmont, is the Adams County Community Foundation. It's located on 2nd Street here in Decatur, right next to the plaza, but they have a website that you could go to, so it's Adams County Community Foundation. You just type that in into Google, and they offer lots of scholarships that I know in one area that students don't apply for. But that is if you are a senior in high school, so there's, I'll kind of talk about the different types of scholarships here, but it's for 4-year degrees, 2-year degrees, or technical school. And they have traditional students would be, a traditional student would be someone who's graduating from an Adams County school and attending a college in the fall. So that's a traditional student. And then they have on-track students, which would be for students ages 19 to 23. You lived in Adams County at least 5 years. You graduated 1 to 5 years from high school prior to applying, and a current college student or plan to enter in the fall. So that's kind of traditional would be a student who's applying like in January of the year they're going to graduate, and then on-track student would be students after that. So you can apply as a senior in high school, and then after that you'd be an on-track student, and then you can apply each year. So they have different scholarships for, one's for traditional, one's for on-track. I do want to talk a little bit about the on-track because that seems to be students might do it their senior year and then they forget about it. A lot of students that were like, I said, well, did you apply for that? Oh no, I thought it was only your senior year. But it's, you could be an on-track student, you can do that up to 5 years. So, so that the application is on their website, you just fill that out. And I believe if once you do it the first time, then you're just doing an updated one, so it's not as involved the next year. But you're going to want to check that out every, like I think if you're an on-track student, that's going to be like in the spring, because my daughter and son just did that as they've been in school for several years. But one of the parts of that is the technical side. So there are lots of monies for those students, and those students either don't know about, I don't know if we just don't do a very good job notifying those students of the monies that are there, but my son is a technical student. He goes to the University University of Northwestern Ohio, UNOH in Lima, and they actually email him every year and ask him to apply because there are so much monies that are not being utilized. So if you're like into, like you want to be, go to school for automotive or diesel or welding, things like that, that would be what you could apply for, or cosmetology. So money's there because they are asking for them to apply for that because there's a lot of money available. So those are just a few things, and you can do that every year, but you need to fill out, probably if you're going, if you qualify the first time, or if your university requires you to fill out the FAFSA, you need to do that as well. You want to do that October 1st of every year that you're going to attend school the next year. But then also our local scholarships, there is money available. My children have received a lot of aid through our local, as well as doing, your own Google searching and looking for scholarships that way. So those are just some ways that you can get some free money to help with the cost of college. So that's what I have.
Okay, so Mr. Bailey is going to be talking about loans and other big stuff. We don't really understand it just yet, and hopefully this will help you understand it. So I will let you.
All right, thank you. Thanks, Victoria. I'm Steve Bailey, and I do work for a small bank, work for community banks. So what I'm going to tell you is a little bit of a bias toward community banking, but I think what we're going to talk about is applicable whether you bank at a community bank or you bank at a national bank or you bank around the world. She's going to talk about just some of the basics, kind of the basics of what banking looks like, and what the accounts kind of look like. Talk a little bit about investments. I know sometimes, especially at the bank and as individuals are entering the workforce, one of the questions you may get asked by your HR department as you're getting ready for your first job is, well, what do you want to do with your retirement funds? Now, retirement feels like ages away, but you start planning for that and investing for that with your very first job. And so there are some options there that we can talk about from an investment standpoint. We're going to talk about loans. We're going to talk about credit cards and debit cards. Talk a little bit about fraud and a little bit about credit scores, which is kind of how the financial world looks at you and kind of evaluates your risk. So just to start out, banks have kind of diverged into what we refer to as brick and mortar banks and online banks. And so I know in many cases, especially for a young person, you may never need to go actually physically to a bank. And that opens up an option for you to basically bank online. And I know there are a lot of online options that are banks and what we call neobanks or nearbanks that you can do a lot of the things there that you can do at a bank. This is where my community bank bias comes in. The problem with those online banks or the online-only bank is what happens when you do have a question or an issue or some problem comes up and you really don't have somebody to go to. So what we have found is that for the most part, our branch operation or our brick and mortar operation, or if you want to go to the bank branch, anymore you go there maybe to open an account, or you go there if you have a problem. You don't really go there anymore for transaction-related things like cashing a check or getting cash or sometimes even getting a loan. You do all that online. But what happens when things don't go the way you plan for them to? And then you may need to actually go physically in to visit with a banker. You may go to a drive-through to get cash or to cash a check or to make a deposit of some kind. But anymore, you can deposit a check with your phone, and you can do really a lot of things just digitally anymore that we haven't been able to do historically. But I think of the online service as kind of what we refer to as transactions. So if you need to make a payment, or if you need to write a check, or if you need to cash a check, or if you need to get cash, those kind of things lots of times you can deal with online. But when you need to go to the branch, to me, I like to have my banking relationship where if I need to go to a branch, I can find one, and I can go visit and sit down across the desk from a banker talk about my particular needs with somebody who I can see eyeball to eyeball with. And again, maybe that's as people get more and more comfortable with social media and with online activities and online banking, that need may go away. But again, that's a service that most banks will provide. They'll have a branch somewhere that you can go to. Anymore, you may have to drive. There may be one in Fort Wayne that you may have to go to, or there may be one in Indianapolis, or in our case, there's one 10 blocks away. So it's just that's what when I think about transactions, I think about banks. I think about what can I do online and what do I need a physical branch for. When we think about what I still refer to as a checking account, when we think about it as a transaction account, an account that money goes into and out of, that's when we think about you may have a debit card on that account, or you may write a check. You may never write a check in your whole life. I know that. I know that happens. And we're seeing that in our banking business too. We're seeing the volume of checks really go down that are coming through our bank. So lots of those transactions are going either to debit cards or to mobile wallet or to some way that does not be transacted physically with a piece of paper or a check. But if you, in thinking about that, you may need to write a check someday, and so that's something that you shouldn't be intimidated by. Writing a check is really a pretty easy thing to do. If you have a transaction account, it may come automatically with a book of checks, and you may never use those. But if you need to write a check, it's just a matter of writing the date on the check. You write who you're paying, if that's ABC Cinema, you're going to go to the movies, and you need to write a check to get into the movies. You write the ABC Cinema, you write the amount of the check, you write it both in long form, in words, and you write it in numbers, and you sign it, and that's it. And then that check basically comes back, and eventually that money is withdrawn out of your transaction account or out of your checking account. Typically anymore, I think you're probably going to use a debit card or mobile wallet to transact against that account. So if you pull your debit card out and you're going to the movies, you use your debit card there and you'll swipe your debit card, and that money will come directly out of your account that day or the next day. Use your mobile wallet. You can use Apple Pay or Google Pay, and lots of times that will be connected to a transaction account. So there has to be a place where your funds are housed, so that Apple Pay or Google Pay can transact against. Or Venmo or whatever you're actually transacting with. I recommend that you don't leave a lot of funds sitting in a PayPal account or a Venmo account or a digital account. I think those funds are pretty vulnerable there to being to fraud or being lost or being stolen from you. So typically, the way I've got my account set up, my Venmo account basically empties out into my checking account, and I'll feed my Venmo account out of my checking account. But that's one way to use those P2P payment services, Venmo or Cash App, or I'm not sure what they all are, but I use Venmo. So those are just some ways to think about a transaction account or a checking account. We used to spend a lot of time, I used to lecture my kids, reconcile your checking account, and probably that term doesn't even mean anything to anybody anymore, because the thing that has happened with our banking system is that activity happens almost immediately inside of our bank account. So if I go to Walmart and use my debit card and charge and pay $30 for a Walmart transaction with my debit card, that money is taken out of my checking account that same day or the very next day. Back in the day, back when I was a young banker, and we talked about reconciling checking accounts, I'm going to write you a check, Victoria, and I'm going to write a $30 check to you, and you may not cash that check for days or weeks or months. And so we used to worry about, okay, I need to set money aside to cover that check whenever you finally decide to bring it to the bank and cash it. We don't really have to worry about that anymore with these digital transaction services because it happens so fast. It's nearly real time. I pay you with Venmo, and that is kind of a real time transaction. There's not this big delay built up anymore. And so, as much as I hate to admit it, I don't reconcile my checking account anymore because if I go to my online app or open up my app and say, okay, my checking account says it's got $200 in it, unless I've done something this morning to impact that, it probably really has $200 in it. It's not waiting on that $50 check that I reviewed to come clear. I really only have $150. So we used to reconcile our account to make sure that we knew what money was available. For those of us that are getting lazy and older and don't like doing that anymore, I can open my app up and see, oh, my checking account's got this amount of money in it, and feel pretty comfortable that that's what I've got to spend. So that's something that has changed over the last several years as we moved away from checks and more into real-time digital services. I wanted to talk a little bit about ATMs and drive-thrus and debit cards. Again, that debit card is the way that we can pay for things, but it's also a way that we can access the cash that's in our account. So you can take that debit card and go to an ATM, which is an automated teller machine. Typically, they're sitting at a branch, or they may be at a convenience store, they may be somewhere else. You put that card in. Typically, again, you will have a PIN number for security. You'll input that PIN number. Make sure you don't share that PIN number because once I've got your card and I've got your PIN number, basically I've got everything that's in that account. So don't share that PIN number with anybody. Keep your card protected. But you can take that then and you can get cash. Lots of times, if I can't find an ATM, I'll go to a Walmart or somewhere. It's usually they'll give me cash. I may buy a pack of gum and tell them to give me $20 cash, and it all works. So, and believe it or not, Walmart gets paid for that. There's a through the Visa network or the MasterCard network or the card network of whatever your card is, they actually get compensated for that transaction. So you don't have to feel bad about doing that. They're getting paid. So use their cash.
Something to remember about the cards when you have a debit card, if you lose it, you can't go into your app for whatever bank you're at, and you can turn off your card and freeze it so nobody can use it.
Absolutely. That's a great point. You can freeze that card, and you can usually even order a replacement card right from that app. Again, that's a place where if you've got a branch in town, you can actually go to your bank branch. I know in our banks, they can actually produce a card and hand it right to you on the spot. So that's a real convenience. If you get used to using that debit card, you can take that debit card and store it in your Apple Pay and use that. Use it that way. You can swipe the card or wave the card, pay wave they call it, and wave your card in front of the card reader. But yeah, if you lose that card, you can get online and use the app, and you can actually shut that down, which is a great service. It used to be when you call the number on the back of the card. Well, if I've lost the card, there's no number there to call, is there? So yeah. Now in our case, it's called Card Guard, and you can actually do that right inside of our app and block your card. And lots of times cards will be misplaced, and so you can actually freeze the card. That'll give you a couple of days to try and figure out where I lost it, or did I give it to somebody? In my case, give it to somebody who forgot I gave it to them so they can use it. But then when you find it again, you can unfreeze it. But if you actually report it lost, they will cancel that card immediately. So even if you find it again, you've got a replacement card that's on the way, so your card is no good. And lots of times you're going to, in my case, you may store that card in several places to pay this with or that with automatically. Then if you get a replacement card, you've got a whole new card number with a new expiration date and a new security code associated with it, so that you've got to go back and read and all that stuff. So that's something that I would recommend is if you think you've just misplaced it, don't actually cancel it and order a new one. Just put it on hold. give yourself a couple of days maybe to try and remember where you put it, or maybe it's maybe fill out your wallet's in the car or wherever it's at. But then if you do end up that it's lost, you can cancel that and they'll issue you a new one. And in most cases, that's all free of charge. You don't pay for that, so you don't have to worry about that. Drive-through, we talked about even a drive-through. You know, how that experience. One of the things that in the banking business we know is that sometimes the interaction can be kind of intimidating, a little scary. I have to go see my banker. Oh my gosh, do I have to dress up? Put on a suit? None of that stuff. You don't have to worry about that. No special dress code to come to your bank. Just come in and talk to us. We're just real people, just like you are, and we're just there to help you. So if you want to open an account, we have really great people in there that can kind of talk you through what do you want to do with it. There are a lot of options with bank accounts, with checking accounts, even options with checking accounts. Some checking accounts are digital only, and that's the kind of account that you and your friends probably will gravitate to. I don't need checks. I don't need physical anything. I just want to be able to put my account, access my account through Apple Pay and Venmo, and I don't need any of that other stuff. Or you can have more of a traditional account with checks and statements. You get a digital statement, or you want me to send you something in the mail, or all those questions that can come up, and your banking representative will walk you through and tell you what that means and answer any questions you may have. So don't hesitate to either in the lobby or in our drive-throughs, just talk to that banker just like you would anybody else. Hopefully they have some specialized knowledge in the banking business and what you might need and how that might help you. But it's our job in the banking business to, number one, make banking easy. Number two, make banking friendly. And number three, make banking what you need it to be, not what we need it to be. So gone are the days when we try to sell you things or try to put you in products that you don't need. We're just there to help you get into the account and into the relationship that you need. Now we get compensated for that, and the way banks make money is by using your money. So the good news is, if you have money in your savings account, we're going to pay you for that. But we're also going to take that money in your account and collect that all together, and we're going to leverage that up a little bit, and then we're going to loan that back out, in our case, into the community. So your savings account that you may have with our bank may be helping fund the car loan that Jamie needs, and she's got to go out and get a new car. So that is kind of this big circle, and bank is just kind of a financial intermediary. I like to say we take people with more money than they need and put it in the hands of people with less money than they need. So we're just kind of the intermediary to make that happen. And we're a for-profit bank, so we have to do that in a way that makes money. We have shareholders that we answer to. And so, but that banker is just there to help you create a better financial life for you in your future. So I really do believe that. We've talked a lot about checking accounts, but I want to talk a little bit about our savings accounts. And savings account is a place where you may put money that you don't need right now, or you may need in the future, but you don't need it right now. So you put that into kind of, I call it a reserve. It's money that you set aside maybe for a future purpose, or it's money that you set aside just for a rainy day. I don't need it right now. I'd rather get it out of my checking account or out of my transaction account so I'm not tempted to spend it. Or maybe you say, I want to save for a vacation, or I want to save for a new car. And you say, okay, I'm getting a paycheck now. This is all cool. I have money to allocate to different things. I'm going to take $50 out of every paycheck, and I'm going to put it aside, and I'm going to save it for a vacation. I want to go to over in the summer. I'm going to go to vacation in New York City. So I'm going to put $50 aside. I'm going to save that money. you can create an account called a savings account, and that money will just sit there, and actually it will grow. The bank will pay you money to let that money sit there. So if you do that, you can do that kind of irregularly or whenever you feel like it, but you can also set that up oftentimes to do that in a systematic way, such that you can work with your employer who you're getting your paycheck from and say, hey, put $25 out of every paycheck into my reserve account or my savings account, because I'm going to save that money for my trip to New York. So put that money aside, put it aside, and it'll happen kind of automatically. It's kind of a neat way that happens, and it'll grow. Lots of times, anymore, the location of a bank is not really that important. My youngest daughter, when she graduated from college, she ended up out on the East Coast, out in New Jersey, and she still banked with our bank back here. So she was on the East Coast, we had no branches out there, she banked back here. Of course, she knew Dad could go into the bank and deal with anything that went wrong, but she didn't need to have that local branch. And that works well until something goes wrong, and then you kind of need to find that banker to help you figure it out. So locations have become less pertinent and less important in the banking business than they used to be. I'm going to talk just briefly about interest, and that is that money that you get paid on your reserve account or your savings account. It's also the money you get charged, or you have to pay the bank if you take a loan. If you get money cash that's not yours, so you're going to go to a new car, you're going to get a loan. Interest is that, we call it the time value of money. So it's the fact that you have my money and you're going to use it and I'm not, so you're going to pay me for that. Or I have your money and I'm going to use it and you're not, so I'm going to pay you for that. That's what we call interest. So that's a little bit about the banking business. It is, generally speaking, all about liquidity. It's about that activity of dealing with my cash. How do I spend it? How do I save it? If I have cash needs, how do I borrow it? We'll talk about loans here in a little bit, but kind of the next level I want to talk about, if you have money that you want to set aside for some future purpose, you may not put it in a savings account. You may put it in an investment type account. And so I just kind of want to talk briefly about that, only because lots of times when you go out and you get your first job, one of the things that your personnel department is going to ask you is, okay, we have this thing called a 401k. And a 401k is just it's a retirement savings account. It's a tax advantage retirement savings account. And so they're going to say, well, what do you want your 401k money to be invested in? And you're going to go, well, I don't know. And so they're going to put it in something really safe, and because you don't know, they're going to put it in something that you can never come back and say, well, you put it in this investment and you lost money for me. That's usually not the best solution for you, especially when you're young, like you all are, and you've got this long time horizon before you think about retirement. You may work 40, 50 years in the work world before you begin to draw money out of that retirement account. So you've got this long time horizon. So you may have some options that would be better to choose when you get that 401k question asked of you. And typically, if you think about things like stocks, everybody's heard of stocks anyway. Even if you don't know what it is, basically a stock is a representative share of ownership in a company. And so if I own a share of the Walt Disney Company, I own a share of that. I own a share of their stock. I own a piece of that company. So, but you have there are rewards that go along with owning a piece of a company, whether it's Walt Disney or it's Amazon or it's Nike or whatever it is. Some of those rewards are basically you could get paid a dividend. It's called. You could also see the value of that go up, and it's called stock appreciation. There's another investment called bonds, and those are basically, you would own a piece of a loan to a company. There's something called mutual funds, or and a mutual fund is basically a group of investments. And so that's another option that you may think about with your retirement money. And that's similar to something called exchange-traded funds, or ETFs. But those are just all investment options that you may have for your retirement money. You can put it in a savings account, or you can invest it in what we refer to as the market. I only tell you that this is not, I'm not licensed to talk to you about different stocks and bonds and making recommendations, but I just tell you that when you've got this long time horizon, you want to use that time to your best advantage. And frequently that's not with putting it into a safe, government-insured, some kind of a savings account. It's more, it's taking a little bit more risk with that money. Because you've got time, if kind of things go badly, you've got time to recover. And so you've got the value of time on your side. For instance, just real quickly, the S&P 500, which is a group of stocks that are the largest stocks in our country, in the United States, over the last 20 years have yielded about a 10% return on that investment, versus about a 3% return on a more traditional risk-free investment. And you've got, again, just over time. Now, if you had money in the stock market in the last couple of years, it's kind of struggled a little bit. It's been up and down. But if you've got that long time horizon, you can even all that out. You can ride that average growth, that 10% average. Again, it may be different going forward, but that's what historically the last 20 years have shown us. Investments, in my opinion, investments are all about diversification. So you're looking to basically, diversification is having your money invested in a lot of different things. So if one particular thing goes down, maybe there are 3 or 4 other things over here that are doing well. So that diversification just allows you to kind of spread your investments out over a lot of different types of investments, a lot of different individual investments, and again, over that long period of time. Again, this is money that you won't need for a while, so put it away and forget it. But what you'll be asked to do, again, back to that HR department question about your 401k plan, where do you want to invest this? You'll also put it away and forget it. So if you kind of make a really safe decision, or if you let them make that decision for you, and it goes into a very conservative type of investment option, you probably won't think about that again until somebody says, have you looked at your 401k lately? What 401k? Well, that's that thing that the HR department talked to me about whenever I started work. And somebody says, well, yeah, mine's doing really well. So, well, I wonder what mine's doing. So then you'll go back and you'll think, God, I don't even remember talking to anybody about that. Just something that is do a little bit of research, a little bit of knowledge on, talk to a friend, but it's something that you need to make a conscious decision about. You can't just ignore it. Because back 30, 40, 50 years ago, there was something called a pension plan, and that was kind of this guaranteed payment that we all counted on, was going to be there when we retired, and was going to take care of us in retirement. Those days are gone. Now we have this 401k, or this retirement fund that we fund, but we get to make the decisions on where that money is invested. So we have to be smart about that and think about it. Next thing I want to cover real quickly are loans and credit. Everybody needs a loan from time to time. There's nothing bad about getting a loan. With the price of cars these days, if you have cash to go out and get a car, good for you. But if you don't, that's okay, because that's what banks, again, we take that money from people that have more than they need, and and we allocate it back out to people that need more than they have. So that's the other part of that equation. So don't hesitate to go speak with your banker or credit union, or even at the car dealership. Lots of times they'll help you out with getting a loan. You may get a loan, say we're going to go out, we're going to buy a relatively nice car, we're going to spend $30,000 on a car, or we're going to borrow $30,000. We're probably going to spend more than that because they're going to ask for a little bit of a down payment. So you may expect to make typically on a car, you may make about a 20% down payment. So if I'm going to borrow $30,000, I may have to make a $6,000 down payment, but you may spread that payment out over a period of time, or payments, typically monthly payments. You can go 24 months, which would be 2 years, 36 months, 3 years, all the way out to, I've seen them out to 84 months. You know, so those are long period of time. I would just tell you to be careful that you don't extend that out so far that you owe more on the car than what it's worth when you decide you're ready to trade it off or do something with it. For instance, if you're going to borrow that $30,000 at, say, 6% interest, and I'm hearing now that that's low, but that's kind of been an average over the last several years, it's about 6%. If you're going to pay for that over 36 months, that payment would be a little over $900 a month. That's a pretty stiff payment for me. I would struggle with that. If you're going to pay for that over a longer period of time, say 84 months, that payment's $440. So that's about half. But just think, over the life of that loan, when that car's paid off, on the 36-month payment, you're going to pay about $33,000 total. You're going to pay about $3,000 interest, and you're going to pay back the principal that you borrowed, that $30,000. But if you spread those payments over 84 months, you're going to pay almost $37,000. So the first example, you paid about $3,000 interest. In the last example, you're going to pay about $7,000 interest over the life of that loan. So the privilege of extending those payments out, you're going to pay for that in more total payments at the end. The payment per month is going to be less, but the total payments are going to be higher. So be careful when you're getting a loan. Don't just think payment. Think a payment I can afford, but what's over the life of that loan, what's it actually going to cost me? And does that make sense to me? So that's something you just want to watch out for a little bit. Typically, when you come to a banker to get a car loan, or really any kind of a loan, we're going to think about getting that payment back. So the collateral, which would be, in this case, would be the car, or if you're taking a home loan, the collateral would be the home itself. We want to make sure that in the worst case scenario, and you can't make your payments on whatever that is, the bank will typically go out and they will, what we call repossess or reclaim the collateral. They'll take that collateral from you and they'll take it back. And then they'll sell that collateral and basically try to pay off your loan. It's always our desire, it's never our desire to do that. It's always our desire, if we have to do that, that we have enough collateral to totally pay off the loan. So that's the reason you may have to make a down payment, because we know, you know, and I know, when I drive that car off the lot, it's no longer worth what I paid for it. So the bank doesn't want to really have an obligation out there, and you don't want to have an obligation that is more than what the value of that vehicle is, or that car, or that house, or whatever it is. Once you decide to liquidate it, you want to have basically the collateral value, the value of the thing that you're buying, be equal or greater than the loan that you have, that you took out to get to buy it with. When I say liquidate, I'm talking about selling. So if the bank takes that car back, we will sell that car again. When we do that, though, we don't just get the money. We have to actually take the money and pay off as best we can your loan. So we have an obligation to do that in a way that that treats you right, that doesn't take advantage of you. So we'll sell that car or liquidate it in the most advantageous way we can. It also has to be expeditious. It has to be relatively easy for the bank. So we're not going to put an ad, usually an ad in the paper, and try and sell it. We may sell it to somebody who's a wholesaler, and so they would buy it and resell it. But once we have liquidated that vehicle then, or that collateral, we have an obligation to reduce your loan by whatever it is that we got from selling that vehicle. But if there's still a balance, you need to understand this, you still have an obligation on that balance to us. So just because you bring the car back to us and say, can't make the payments, here, you keep the car, we'll go through this whole process, but there may still be a balance left on your loan, and that's a really sad day. When you say, I don't have the car anymore, but I still owe you, that's like, I don't understand that, but the bank is going to reduce that loan down as much as they can, but they may not be able to totally pay it off, and so then you still have an obligation to make that payment. And the same process works when you're ready to buy a house, when you're ready to buy a home. Home mortgage is very similar. Lots of times the term would be, the length of time you can pay off a home is up to 30 years. I think there are cases where it can be longer than that. But at our bank, it's up to 30 years. So if you think about that, a home lasts a long time. Think about a car. A car basically over time, the value goes down. Homes lots of times over time, the value can actually go up. So that's actually usually a pretty good investment for somebody, is to figure out how to buy that first home. Once you buy one, it gets easier every time after that, because you start to build up a little bit of equity, you build up your credit rating, and we're going to talk about credit ratings here in a minute, but those are all things that your banker, again, can help you think about and wrestle with and answer all those questions that you may have. Credit, when I talk about credit and loans, I want to talk briefly about credit cards, because I know young people can really get in trouble sometimes with credit cards. Credit cards are an easy way to buy something and not have to pay for it immediately. The problem with credit cards are that they have a very high interest rate, in the 24 to 28% range. So if you think about a 6% car loan versus a 24% credit card loan, you would never, for instance, want to take your credit card to go buy that car, because your payments would be significantly higher than that, and the interest you would pay would be multiples of what you would pay on that car loan. I like to talk to people about credit cards, say use them only for short-term liquidity needs, short-term cash needs. In the best case scenario, have a plan for how you're going to pay that credit card purchase off in the next month or 2 months or 3 months at the most. So you can do that then, and you can pay for that a little bit at a time, but don't plan for that to be over a long period of time. A couple of months at most, if you're going to put something on a credit card. My best advice is, if you have a credit card and you purchase something on your credit card, you need to be prepared to pay it off when that credit card statement comes, so that it gets back to zero every month, and you can start over again. That's something we call revolving credit, so it kind of can go up and down and up and down and up and down. Or a car loan or a mortgage is what we call a term loan. So you're gonna borrow at the amount of the loan, and then it just goes down as you make payments, but it can't go back up. That's the difference between a term loan and a revolving loan. I told you about the 36-month car payment, $30,000. At 24%, if you put that on your credit card, instead of $3,000 interest over 36 months, you would pay almost over $12,000 interest over 36 months. So 4 times as much interest if you put it on your credit card. So don't put a long-term purchase on your credit card. Always a bad deal. Credit scores is something that we talk about, is something that may be of interest to you. A credit score is the way a financial services company looks at the risk you present to them as a borrower. So a higher score, a higher number, indicates that the likelihood that that bank or that credit union or that lender is going to get paid back from you in a timely manner, and you're going to make all your payments, and everything's going to go according to the plan, the likelihood of that gets better in their eyes as that number grows. So for instance, if you have something in the neighborhood of 700-ish, 680 to 720, that's a pretty good credit score. And banks will look at you favorably and you get favorable interest rates. If you have a score that's under 680, maybe in the 640s, 500s, 400s, banks are going to look at you and say, I'm not so sure I'm going to get my money back. And I may have to go through repossession, and that's never a fun thing, and it usually doesn't work out well for the bank. So you want to work to build that credit score and have a good credit score. Protect your credit score if you get it, and don't let anything kind of get in the way and mess that up. Some of the things that can help you build that score up towards I think I should know this, but I think the maximum credit score is like 840. So as you start to grow that credit score, and maybe it gets in the 700s, and maybe you're starting to build it a little bit, you do that by making all your payments on time, because all those, as a bank, we have to report your payment history out to the credit reporting agencies. Equifax and TransUnion, and there's the third one I should know off the top of my head, but I don't. These are companies that are in the business of producing these credit scores for us. So if you make Experian Boost, you hear about Experian Boost. What Experian Boost is Experian Boost has a methodology by which they take payments that you make normally, routinely, that wouldn't necessarily be reflected on your credit score, like maybe your electric payment, your utility payment, your internet payment, your payments that are not necessarily, we report loan payments, but we wouldn't report any of those other payments, but they have a process by which they can collect some payments that are typically not reported, and they can help you boost that score up by getting more payments reported for you. So make on-time payments, don't be late, keep your credit utilization low. So if I've got, credit cards usually they always come with a credit limit, with one exception I can think of. They always come with a credit limit. So if I've got a credit card with a $5,000 credit limit, and it's always at $5,000 all the time, that's what we call high credit utilization. And that's usually a sign of somebody that's struggling financially. So that's a negative on your credit score. But if you have that same $5,000 credit card and you pay it off every month and it keeps a zero balance, that's a low credit utilization, and that's looked on favorably by credit reporting agencies. So that would help boost that number up. So typically, I like to tell young people to get a credit card with a low maximum balance, so you don't get yourself in trouble. Use it regularly, pay it off every month, and that begins to build some credit history, and you start building that score. So it's like, yeah, this person is a trustworthy person. I can give them a loan, and they're going to pay me back because, see, they have this track record, this history that shows that they can do it, and they're responsible. So they'll make those payments, and I trust them.
I think certain things, like, for credit, we better use it for, like,
want to match the duration of my credit with the duration of what I'm going to buy. So I would not, unless you're just using it as a transaction mechanism. So you're just using it and you're going to pay it off, you're going to use it, you're going to pay it off. Then you can buy anything with it. But if I'm going to buy I wouldn't, for instance, want you to go out and get a 3-year loan to buy groceries with. That's probably an extreme case. So you wouldn't want to pay for your groceries over 3 years. I'm going to eat that. I'm going to eat my groceries next week. So you want to kind of match the length of the asset that you're buying, or whatever you're buying. What kind of lifespan does it have versus what is the lifespan of my loan have? So car, 3 years, 4 years, 5 years, 6 years, not 30 years. We know that, so we're not going to get a 30-year loan for that car, but we may get a 3 or 4 or 5-year loan for that car. House will last 30 years, 40 years maybe, so we could get a 30-year loan for that car. So yeah, you typically want to match the length of your loan or the length of your credit with the duration of the asset that you're going to buy. If I'm buying groceries, I would typically not want to put that on any kind of credit because they're consumed so fast, and I don't want to make a payment on that bag of potatoes that I bought today. I don't want to make a payment on that next month. I ate them 3 weeks ago. I don't want to make that payment next month. So just think about things like that. Some people will use credit like for points. So you may hear people talking about credit points. Only get into that game if you're absolutely certain you're going to pay it off every month. Don't play that game unless you have the resources to pay your credit card bill every month when it comes in. No questions asked. Yeah, like I said, establish a little credit early and then use it. Something that hurts your credit are what we call credit pulls. That happens every time you apply to get a credit card. You apply to get this credit card, you apply to get that credit card, you apply to get a loan. Those are all, the lender is going to go to the reporting agencies and check your credit score. And that's what is referred to as a credit pull. Very many of those, and again, you start to look desperate. Like, this person's desperate for a loan. They're applying everywhere. Look at all these credit pulls. So again, it's all in risk management. From the banker's standpoint, it's managing that risk. So things that hurt your credit score are exactly the opposite of what we talked about. You know, late payments, high credit utilization. One thing I will tell you is don't co-sign for somebody. If you co-sign on a loan, whether you co-sign on a credit card, you co-sign on any kind of loan, you become as liable for that debt as the individual was that actually took the debt out. So I always recommend to people, don't co-sign. Last thing I want to touch on today is financial fraud. And I just want to tell you, you just can't be too careful. There are terribly brilliant people in this world that have nothing better to do than to try to figure out how to separate you from your money. So, things that appear too good to be true, they probably are. If all of a sudden I can buy that $30,000 car from somebody for $10,000, that's probably not real. It's not real to expect that to happen. And there's some hook in there that they're going to try to get me to give them my bank information. They're going to try to get me to write them a check or give them some money up front. They're going to try to help. They want me to pay to ship that car or something to me, pay the shipping up front, and they'll send the car. There's all kinds of, every day there are hundreds of new scams created to try to separate you from your money. What we call phishing emails, or an email that you may get, or a text that you may get that is asks you to respond to something, or asks you to confirm something, or even just asks you to call somebody. These scammers are very good. Once they make contact with you, at feeling their way along to find out how to get into your confidence, and then they can begin to get into your financial information, and they can begin to get into your money. So be really, really careful with schemes, eBay schemes, credit card schemes. If somebody wants to give you a credit card and say, well, we're going to give you $200, take this credit card, and then just cancel it. If you think about that, that just sounds too good to be true, doesn't it? Probably is. So you go away to college, lots of times credit card companies will be there just trying to shove cards in your hand and give you all kinds of things to get their card. Unfortunately, they believe that if they get you using their card, you won't be able to pay it off. You'll incur that 24 or 28% interest. You'll incur a $15 a month late fee. That's how they make their money. They don't make their money by basically loaning you money and getting paid a reasonable interest rate. They make their money when you make mistakes with that card they're trying to put in your hand. So just be very careful with that. Lotteries and games that you win and you're a winner, just email this or collect this or click on this link or whatever. Don't buy it, because they are really good. Once they've got you on the hook, they're really good at figuring out how to get into your pocket. I'm kind of at the end of my notes and I've talked way too long. Questions? Anything? What did I miss?
With the credit scores, so when does that become, when does that start for each person? Is it a certain age or when you do a certain action?
You know, I think once you begin to build a credit history, you're going to be able to build a credit score. So if you never have any credit, we have folks that come to the bank to get a loan that have 0 credit score because they've never had credit in their life in their name or in their social security number. So if you've never had any credit, you probably have a 0 credit score. So to build that score, that's why I said I recommend. I remember my dad, this was back in a long time ago. My dad took me to the bank when I was very young. He co-signed for my loan, so I said, don't co-sign, you can co-sign for your kids. Co-signed for my loan, but he put a loan in my name so I could begin to build that credit history before I was eligible, before I was legally eligible to sign. So it was before I was 18 years old. I had a loan in my name. I was starting to build that credit history. He made sure I had a plan to pay it off, made sure I paid it off, but I think once you begin to build that credit history, even if you get a credit card, like I said, get maybe a credit card with a $500 limit on it, and then make sure you pay it off every month when that bill comes in. Never be late. Never be late. And you'll begin to build a credit history, you'll begin to build a credit score. But you can do that as early as 18 years old. Other questions? Anything else? Okay. Sorry I was so long-winded. Okay. I think that's all I have, Jamie.
Okay.
Questions? Jamie? Anything?
I don't have anything, thank you.
Okay, so if you guys have any questions, you can comment on the video. We will get in touch with either of them and ask them for you and get back to you on that. So don't be afraid